Welcome to our Genesis Capital Management Ask the Local Expert webinar. Thank you for joining us. We will just wait a few minutes as attendees continue to join us. My name is Jill Bester, and I'm an Associate Portfolio Manager with Genesis. Today, our presenters will be sharing a case study on a tax, trust, and estate planning scenario. The characters in this case study are fictitious. However, we are seeing the scenario more frequently with a greater amount of wealth transfer occurring. I have the privilege of moderating this session with Jen Bogwald of MMP and Trina Brubaker with our good friends at Johnson Franklin Bishop. Jen is passionate about helping business owners and empowers these clients with information they need to make good decisions. As a business advisor drawing from more than 20 years of experience, she is based at MMP Nanaimo and serves clients across the island. Jen supports community-centered business owners to allow them to grow meaningfully and successful businesses. Jen strives to truly understand her clients and contribute valuable advice and insight as an integral member of the team. From increasing the value of your business through strategic planning to taking care of estate planning matters, she works for clients and customizes each step to their specific goals. Designated as a chartered accountant in 2006, Jen also has a Bachelor of Business Administration from UBC. Jen values people and relationships above all. She keeps her balance through spending time with her young family. Our lawyer, Trina Brubaker, practices in the area of real estate and wills and estates, and particularly enjoys the planning aspect of these areas of law. As an associate with Johnson Franklin Bishop, Trina works with clients throughout Nanaimo and the surrounding areas. She believes in taking a team approach and works well with other advisors, and I can attest to that, in order to create the most efficient plans. Trina has been active in Nanaimo since arriving at Johnson Franklin Bishop in 2012. She's involved with the Rotary Club of Nanaimo Oceanside, the Young Professionals of Nanaimo, the Nanaimo Foundation, and the Trial Lawyers Association of British Columbia. Originally from Lake Cowichan, Trina maintains a close connection with the Cowichan Valley. She is an avid football fan. Sadly, she cheers for the Dallas Cowboys. I have personally worked with Jen and Trina in planning discussions with our mutual clients. I appreciate their knowledge and insight. Before I turn it over to Jen and Trina for the case study, just a few housekeeping items. You will have the opportunity to ask questions in the chat section at the right of your screen. Questions will be answered at the end of the session. Throughout the session, there will be poll questions as well. All of these questions and poll answers are hidden from view from the public. Just the presenters will be able to see. We're going to get started actually right off the bat with our very first poll question. And our first poll question is, do you feel that your family's plan is in order? Just wait for those poll question answers to come in. Just a few minutes. Oh, great. Somewhat seems to be leading the pack. Oh, we have yes. I love the honesty of who has quite bluntly said no. And I hope you got some insight today.
Well, and Jill, thank you so much for the fabulous introduction, and thank you to Janice for hosting us today on a really important topic that I know is of interest to all of you. So it looks like we do have a very organized crew here, so fantastic. I am going to let Trina introduce our case study facts here.
Absolutely, thank you, Jen, and again, thank you for having us. I'm thrilled to be here today. Our case study today focuses on a blended family, a couple, Todd and Jennifer. Todd was a very high-profile quarterback, but unfortunately, after being caught in a cheating scandal, he lost his job and had to pay significant fines. As such, he's no longer playing in any league, he has no income, and he's been refused for any commentating or other broadcasting positions. Well, he and Jennifer have managed to work past this. They still are having difficulties, and they felt that they needed to be a bit more isolated, and they've relocated to Salt Spring Island. And Jennifer's main concern right now is structuring her income in a way that protects their family. And their family makeup consists of, they have twin children of their relationship, and Todd also has a child from a prior relationship. Jennifer has been quite successful herself. She's a now retired supermodel who recently sold her organic skincare line, Refresh Skincare Corp, for $5 million. Jennifer's intention, which hasn't been put into place yet, is to loan Todd $1 million through a spousal loan, and then to create a family trust. And her intention will be that only she and the twins will benefit through this family trust. And Todd will make use of the $1 million spousal loan, and he will take care of providing for his son from his prior relationship through his own will. The parties do own the estate that they've purchased on Salt Spring Island. They own it outright, clear title and cash. Right now it's valued at approximately $1.2 million, and it's owned as joint tenants, and the parties do intend that the surviving spouse, if one spouse passed, they would receive that asset outright and retain the family home.
And you can see why I let Nina introduce the facts there, because obviously this football case is near and dear to her heart. And you know, some of the things that are outlined there are, I wanted to just outline their current situation, and Trina had made mention of a couple of planning opportunities that Jennifer is looking at. But first I wanted to review with everyone the case facts as they sit from a tax perspective, what it looks like. So leaving everything just the way it is, Jennifer has ended up with $1 million of cash in her personal name from the sale of her business. She sold her business, however, she still owns her corporation that held her operating business before. So she did not sell shares, she sold the assets of the business. So she's got a residual value of $4 million at the corporate level. As she plans to not spend all that money right now, she is seeing this as a bit of a retirement fund for her and Todd. In the past, of course, Todd was the high income earner, so he's never been a part owner of this business, never needed to. But now she's seeing this as a bit of a fund for her and Todd for her retirement. She doesn't have a mortgage, they don't have huge spending needs, so it's not that they need a bunch of money right now, but in the future they'll want to draw down the value. So 100% of it's owned by her right now, and if she was to wind down the company right now and just get rid of that extra layer of complication, there would be a significant tax bill. So she would have to take out that $4 million into her personal name, and it would get taxed as a dividend personally. So, you know, she would end up with, say, maybe 2.2 million of that 4 million in her personal name, if she really wanted to wind down this company. So she doesn't have any desire to use the money right away, so no, that's not something she wants to do. But the other thing is that as she invests, say, this $4 million portfolio, say with Janice, it's going to grow over time because the earnings on the portfolio are going to be in excess of her actual cash needs. And when I say the earnings of the portfolio will be in excess, no pressure, Janice, right? But we've got to ensure those returns are strong, just like the last several years have been. The other sort of benefit of the current structure is that she's able to, as an individual, maintain her OAS. Anyway, so if she was to wind this down, she would lose her OAS in the year she wound it down. And she also tells us that she really wants to leave the value of the corporation to her children. And despite not having a will that says that, you know, so we've got to look at this from an estate perspective. And if if she did pass away, the estate would end up having a deemed disposition of all of her assets at fair market value. So the tax burden to her estate would be approximately 25% or $1 million. And that tax would be due on her final tax return. But her beneficiaries would also, and this is the case when we've got people passing away that own corporations, there's the potential for double taxation. So because the estate itself will also have to pay tax on the assets coming out of the corporation. There's strategies for avoiding that, but that's the as-is scenario. It is important to note that if Jennifer's wishes had been to simply move these assets to her husband on her passing, there is what we call a spousal rollover provision available, which would defer the taxes on that deemed dividend on death to Todd's ultimate passing. But in this case, that just wasn't the case facts. She was looking to pass this on to her children. Pass it back to you there, Trina.
So in scenario one, currently Todd and Jennifer fall into what many of our participants fall into with where they are with their estate planning. They're at the somewhat stage. They've discussed this, they have an idea of what they want to do, but they haven't actually implemented their plan and they have not signed off on the appropriate documents yet. As such, right now we want to look at what would happen if one or both of them were to pass away right now prior to putting any type of will, trust, or other vehicle in place. If Jennifer were to pass away right now, as Jen discussed, there would be a deemed disposition. And in addition to significant income tax, her estate would easily be looking at probate fees of $70,000 or more. And my numbers are all very general here, but it would be a very significant amount in probate fees. And because she doesn't have a will, we refer to that as passing away intestate, or the assets going through intestate succession. And this is governed by British Columbia's Wills, Estates and Succession Act. And it has very, very clear rules about how a person's estate will be distributed if they do not have a will. And a spouse is the initial beneficiary. And if there are children, there are schemes for dividing. And it does make a difference if the children are all children of the party's relationship, or if they are children from prior relationships. In this case, Todd would receive the spouse's preferential share of $300,000, and then anything remaining over $300,000 would go 50% to Todd and 50% divided between the twins, because they are Jennifer's children and the child of their relationship. So we are looking, just to give some approximate numbers, that Todd will end up with approximately easily $2.3 million, where Jennifer's children may each receive approximately just over $1 million. And Todd will also receive the family home because that is held through joint ownership. And Todd's son at this point would not receive anything because he is not a descendant of Jennifer as defined in the legislation. So he has no standing and he would not receive anything if she passed away without a will. This scenario does not reflect what we understand Jennifer's wishes to be. We understand that she wants the twins to be the primary beneficiaries. So this does show the importance as to why she needs to put a will into place and a trust. If Todd were to pass away, this is concerning for Todd in scenario one, because at this point, the parties have discussed the spousal loan, but they have not implemented that. So at this point, other than the family home, Todd really has no assets in his name. So if he were to pass away without a will, the family home will go to Jennifer because they own that jointly, and there will be no distribution whatsoever to his children, which means that his son, who also has no entitlement to Jennifer's estate, will not receive anything in this scenario. Finally, if Todd and Jennifer were to pass away at the same time, because Jennifer is the sole owner of the corporation, those assets will flow solely to the twins. Todd's son will not take any share in that on an intestate succession. So they will be holding the $5 million after deduction of taxes and probate fees. The family home, if the parties decided to pass away at the same time, would be divided 50-50 to their respective estates. So of the $1.2 million, $600,000 of that would flow to the twins through Jennifer's estate. $600,000 would flow through Todd's estate and be divided 3 ways because all 3 children are Todd's descendants. So in this scenario, we're looking at the twins each receiving upwards of easily $2.5 million, while Todd's son receives $200,000, which is again not what the parties want. They do not want that much inequity between what the children would receive. So this just emphasizes the importance of initially understanding what will happen if you do not have a will, and then also understanding then what tools can you use. And another important point to touch on here, with these very significant amounts of money that the children will receive, without a will or trust provisions being put into place, in BC, the public guardian and trustee would then manage those funds until the children turn 19. The fee is quite significant that they would charge on managing those funds. And all of the remaining balance will be turned over to each child, their share, as they turn 19. And I think to most of us, these are uncomfortable amounts to think about a 19-year-old receiving. So another very important reason to put a plan into place.
There's a lot of case facts in this, and it is definitely was not Jennifer's intention to be in a position to cut out Todd's son in any event. So we, from again looking at, okay, well, what can we do? And it is important to note that every case is going to be unique and every situation is different. So what's worked for maybe your friend down the street or in another family may not be the right solution for you. So what we are presenting, though, is some solutions that we see common that deal with some of the challenges in this planning. So what I'm showing here is what we call an estate freeze. So when we have a huge inequity between spouses, where we have one spouse carrying a significant tax burden on their passing and the other spouse not, and even in any case where we've got an estate burden, we can do what we call a freeze to reduce that tax burden on their ultimate passing. And so you see a new shape on my diagram here, a triangle, and a triangle denotes a trust. There is lots of different kinds of trusts out there, and they're used for a wide range of things. The one I'm discussing is specifically a family trust. So it has a 21-year life, and it's an entity that can hold assets in trust for its beneficiaries. So there's a very detailed trust document that outlines who the beneficiaries are and who the trustee is. So the trustee is key in that that's the person that maintains control over the trust's assets. So in her lifetime, Jennifer would be the trustee of this entity. But the key here is that even though she's the trustee, that does not form part of the assets of the trust, do not form part of her estate on her own passing. So it's its own separate entity. So what we do is we freeze the value, so hence the name, we freeze the value at $4 million, and we give Jennifer back preferred shares, so fixed value shares worth $4 million. And the family trust then participates in the growth of the portfolio past that point. And over time, then, what we do, as Jennifer and Todd require some money in their lifetime. So maybe they take out $50,000 a year, maybe they take out $100,000 a year. But what we do is we show that as a redemption of a preferred share. And then over time, those draws actually bring down the estate value for Jennifer and Todd that this company has. So we have lots of clients where we put freeze structures in place where they're actually sitting with no estate value with respect to their own passing, because the full value of their corporation is held by their trust. So there's more to it. I mean, I don't want to get in, everyone's situation is different, but in Jennifer and Todd's situation, this seemed attractive again because she wasn't planning to spend the huge lump sum that she got from the sale. And this would allow us to keep her OAS and manage the cash flow. And it was a way to sort of stop the value of that estate tax from growing. I think I've covered off all those points. And and do I roll right into this one here? So there are other planning tools. So another one is the alter ego trust. So like I mentioned, there's lots of different kinds of trusts available. The alter ego trust in this case, instead of Jennifer taking back the preferred shares herself, what we do is have another kind of trust, an alter ego trust, own those shares on behalf of Jennifer. So an alter ego trust is a trust that exists only in Jennifer's lifetime. And in this case, there is really, so when they say alter ego, it's like another Jennifer. There's two of them, right? So there's the alter ego trust, and then there's Jennifer from a tax perspective. So from a tax perspective, the alter ego trust is actually just a look through. So it's not deferring any tax. It's not changing Jennifer's personal tax situation. But what it does do is it can protect her assets from the Wills Variation Act. It can also allow those assets to pass directly to the beneficiaries without having to go through the probate process. So in Jennifer and Todd's case, Trina mentioned a significant probate fee connected to her potential estate. And so we did look at the alter ego trust as an option in this case to help mitigate that risk. And when you do have mixed families, there is always the risk that any children can challenge, or anyone named in the will can challenge the allocation. So it's another tool for the business owners and for folks to be able to help direct the executor to ensure the funds go where they intended them to. And another tool. So again, we have lots of tools in the toolbox, but in this case, we had mentioned that Jennifer did end up with $1 million of cash in her hands from the sale. So this is cash that is not shielded by the tax-free account. This is money that actually would be, again, invested with Janice, earning a return every year. And if we were to leave those funds in Jennifer's hands, so she would earn, let's make the assumption that the portfolio is earning on average of 5% a year. She would earn, say, $50,000 on that $1 million investment every year. And Jennifer's tax rate is going to be higher than Todd's. So we've used a 25% tax rate. Of course, your actual tax costs will be dependent on the type of income, whether it's dividends, interest, and capital gains. But for this purpose of demonstration, I'm just using 25%. So she's going to pay $12,500 of tax on her $50,000 every year. So if, like she mentioned, she wants to do a spousal loan, we can lower that tax burden for the family. And that was one of the main things that Jennifer had said to us is, here's what I have. I want to lower my tax burden for my whole family. But she wanted the assets of the corporation to go to her kids, but she didn't want to exclude Todd's children. So the spousal loan was something we discussed as a way of allowing some funds to flow into Todd's estate and within his control. But during her lifetime, she remains the owner of these funds. Not the owner, sorry, her estate still has this amount receivable during her lifetime. So flowing through the tax benefits here, you'll see if Jennifer loans that $1 million to her husband, like if she simply gave that money to her husband, which some of you might be thinking, why doesn't she just give that money? There are income tax rules that would have that income attribute back to Jennifer, regardless of whether you gave those funds to her, because the source came from Jennifer. So you can loan it to your spouse, and you can loan it at an interest rate that's lower than what you're earning. So CRA has what they call a prescribed interest rate, and in July of last year, that prescribed rate actually just went down to 1%. So Jennifer can now loan that money, earning 1% in her name, to Todd, and Todd can earn the money, or earn the income on it at 5%, and then it can be, the net difference is taxed in Todd's hands at his much lower incremental tax rate. So in this scenario where I've run the numbers, we're looking at a $6,000 savings each year that this loan is in place. So again, allowing more capital to be preserved and invested back into the market and continue to work for the family. Yeah, so I hope that makes sense. So Jennifer then claims that 1% of interest income. Todd claims the 5% investment income and deducts the 1% that he's paying over to Jennifer. So in this case, that is what we had recommended and put in place. So lots of savings opportunities for the family. And I think before we go into scenario number 2, I just wanted Trina to give us a little overview or some of the legal tools available.
Plan with Jen, and in this situation there would be a lot of communication back and forth between our offices and with Janice as well, and just making sure that all advisors are on the same page. I would meet with Todd and Jennifer to ensure that all the tools and the proper documents are in place to carry out this plan. And these tools include a power of attorney, representation agreement, and will, and a trust, as we've talked about. The power of attorney and the representation agreement are both what we refer to as during your lifetime documents. And while they don't necessarily relate directly to the plan that we were talking about before, they are very important documents that should not be overlooked. When we are creating these documents, we are generally referring to incapacity planning. So what a power of attorney does is it appoints someone to manage your legal and financial affairs on your behalf. And the reason why this is so important is that in the event that a party potentially became incapacitated, this ensures that someone else can sign, whether it's to make directions with respect to finances, to sign on selling the family home, because there's no default right to sign, whether it's your spouse or child. There's no default without a power of attorney. So this document is just incredibly important to make sure that if during your lifetime you are in a situation where you can no longer manage your affairs, that they can still be managed without any interruption. And on that note, a representation agreement, it provides a similar feature in that it goes hand in hand with the power of attorney, and it appoints someone to make health and personal decisions for you during your lifetime. And this document goes far beyond just making decisions about end-of-life care. If you were in a situation where you didn't have capacity but are potentially going to continue living for quite some time, this is the document that allows someone to manage your care, work with care providers. We cannot stress the importance enough. We do at this point have another poll question. And this question is, are you familiar with the new trusted persons requirement that Janice will need to adhere to by the end of 2021?
Great, thanks ladies. We'll just wait for those answers in regards to those who are existing clients. Obviously, we're happy to have some prospective clients joining us today. So it appears that we've obviously had a hectic year so far to date, and the portfolio managers will be reaching out to you in short notice in regards to this trusted person requirement. We've had a lot of questions during our discussions about the requirement. And I just want to share with you, this is actually BC Securities legislation that has come into fruition. A trusted contact person is a person that you authorize your investment firm to contact if your broker has a reasonable, or in your case, portfolio manager, belief that your account may be exposed to a possible financial exploitation or fraud. So we just wanted to share with you just briefly, because that is something that we will be seeking. Many of you do have a power of attorney on file with Janice. Actually, the securities legislators due to the fact that power of attorneys are often going to be the beneficiary of an estate, sometimes actually request that the trusted person not be the power of attorney because there could be a potential conflict. Some people can't find a trusted person that they'd be willing to share their personal information with, so the power of attorney obviously would be in play at that point. But we just wanted to share that with you. So over the next few months before the end of December, we will be reaching out just to those clients over the age of 60. Terrific. I'll let you continue.
When I meet with Todd and Jennifer, wills are a very important part of what we're discussing. In Jennifer's case, her will is almost a backup because the plan is for her assets to flow through the trust. But as Jen described, it's not an immediate transfer of everything over to the trust. So we need, when we're doing a will, we're thinking about what would it look like if you passed away in 20, 50, 70 years from now, but also it needs to address what would happen if you passed away within a few months from now. So a will is still very important for Jennifer as a backup if she passes away prior to the flow of assets and everything going into the trust. And it gives peace of mind that there is that backup plan in place. A will is a document that is only effective on death, so your will can be changed up until the day you die. So when you have a will, it's of no force and effect until your death actually occurs. And the purpose of a will is to control estate management and distribution at your time of death. So it dictates where your assets will go and how they will be distributed. And on that note, it provides peace of mind is a very important reason for doing a will. And when you distribute through a will, you could do specific gifts, or you can distribute using the residue. And the residue is anything left over. So when you pass away, the first thing that will be paid from your estate, and your estate consists of all the assets that were in your personal name at the time of your death. And the first payments that will go out of that estate will be any expenses, so funeral expenses, debts, and taxes. From there, then specific gifts would be paid. After payment out of specific gifts, if you've left a charity $10,000 or specific amounts to grandchildren, the residue is everything that is left over after payment of all of those amounts, which is a very, very important consideration if your will does have specific gifts to parties. If you have an estate that might fluctuate and go up and down, and if your residue is going to your children, but you have specific gifts to your grandchildren, you want to make sure that you're not running the risk of those specific gifts exceeding the value of what's in your estate and the residual beneficiaries receiving nothing at the end of the day because there may not have been enough to pay out those other amounts. So it's always important to revisit your will in the context of what your current estate looks like and understand what that flow would look like so that the will is still meeting your goals. Another incredibly important part of a will is trusts. And you can do trusts, as Jen said, there are very, very many different types of trusts. You can create an independent trust that's operational now. You can also put trusts in your will that dictate if a beneficiary is under a certain age, you can dictate what age they will be receiving the funds that flow through your will and in what manner those funds should be provided. The most common trusts that I do are when parents are indicating that their children will receive funds. We often indicate that the children aren't to receive those funds outright until the age of 30 or 35, but we give the trustee who's managing this trust discretionary powers so that if the trustee feels it's appropriate, they can certainly pay out amounts ahead of time for what they deem appropriate, whether that be education or a down payment on a home. But what this does, it ensures that this lump sum of money doesn't just go outright into the hands of a child before an age that we feel would be appropriate. Another note on wills that's important, when we talked about the wills, Jennifer's will reflect her wish that her estate does go to the twins at the end of the day. Todd's will is going to indicate that his estate goes just to his son from his prior relationship. These wills are very, if not done properly, from an outside perspective, not understanding the background of why they're doing this, they just look like wills that would immediately be challenged under the Wills, Estates, and Successions Act. And under that act, as Jen referenced, a spouse or a child can challenge if they feel that your will hasn't treated you fairly. So in Jennifer's case, Todd could look at her will and say, this will doesn't treat me fairly. I'm her spouse and I haven't been included at all. In Todd's case, he isn't including his spouse, and he is also not including two of his kids. So in his case, both Jennifer and the twins could look at his will and say, this will is inappropriate, we are his spouse, we are his children, and he hasn't made appropriate provisions. If I was in drafting these wills with Todd and Jennifer, we would do supporting documents that explain why the estate has been set out this way in the event of a court challenge down the road. So if one party did go rogue and decided to act like they knew nothing about the plan or didn't participate, we would have a very well documented file that would explain the situation. It would explain the consents of the parties. If necessary, this might be a situation where we send one spouse out for some independent legal advice, just to make sure that everything is clear if a third party, being a judge, mediator, or otherwise, had to look at this down the road, to understand that these were informed and reasonable decisions that were made at the time. On the trust note, one other thing that came up during Jen's conversation that's important to touch on, if a child or spouse is challenging your will, what that challenge relates to is your estate. They're trying to vary your will, which would mean they're varying the amount that's going to be given to them from your estate. By creating a trust, as we've done for Jennifer, it really minimizes and almost it can reduce to nothing the amount that goes through the estate, and it makes that litigation just that much harder. And that means that if someone was challenging Jennifer's will, it's simply not enough just to do a wills variation claim, because the estate would be zero. So they also have to attack the planning that went into creating this trust, and that is an incredibly difficult thing to attack. They would essentially have to show that Jennifer didn't have capacity to understand the documents that she was signing, which that's an almost impossible argument when you look at the amount of professionals that she would be working with and the time that went into place in putting this plan into place. So it offers a lot of protection, the scenario that we've created here.
And Trina, before you move off wills, I just thought it was worth mentioning that, I hope that most people do have a will, but even if you have a will, I always recommend every 5 years to have someone do a detailed review of it, because life gets busy and more things change than you realize in 5 years. So have a look, read through your wills. It's worth it.
Absolutely. And on another note too, I've heard so many times that, well, I don't need a will yet because my assets just aren't at the point where it's required. Anyone who has minor children, it is so important to have a will, because a will is where you dictate who the guardians of your minor children would be. So if you're thinking, if any of our attendees are thinking about maybe their children, and if you think your children or other loved ones might not be at the point yet, if they have minor children, it's essential to have a will, because that's where you dictate who would care for your children. All right, and then at this point, we do have another poll question. And the next poll question is, have you had extensive discussions with your executor about your last wishes?
Hi, I know from speaking with my clients in estate planning discussion, this is a bit of a touchy subject in regards to the executor and how much they do or don't know. From your experience, Trina, in your professional opinion, how much information do you think the executor should potentially have ahead of time?
It's an interesting question, and it can be very different in different scenarios. So again, this is really where it comes down to your unique situation and family makeup. Technically, you can appoint someone to be your executor without them knowing, because your executor does not have to sign or acknowledge your will whatsoever. It's a horrible idea to not have that conversation with your executor, because they can also decline to act. So if you just put someone without asking them, that doesn't compel them to actually take on that role. And also, just to make sure everyone is clear on what the term executor means, executor is the person named in your will who will carry out those instructions. So they will carry out your distribution wishes. And if trusts are created in your will, in most cases, they will also be the person who manages the funds in that trust and manages them and distributes them. So it's an incredibly important role. And on the topic of revisiting, especially if you have a will that indicates trusts for minor children and your executor will be managing these, you want to constantly be revisiting what is your relationship with that person, what is that person's relationship to your children, and in 5 or 10 years from now, are they still the appropriate person to be making these decisions and doing that management? If you've appointed someone executor, they absolutely should know. They should know how to access your will if necessary. And I'm always torn, and when I think about actually giving out copies of wills, what I talk to about my clients in that situation is the likelihood of changing your will down the road. So if we're talking about a very standard will that is becoming less common, but what we would have said was a standard will in the past, which would be a family where we have 2 parents and 2 children, both of that relationship. And if the will said everything goes to the spouse and in alternative equal shares to the children, that's not a will with a lot of risk if that's out or if that falls into someone's hands, and the likelihood of changing that will is probably not high. When we have a will where children are being treated differently, where we have a blended family, anytime when there is a lot of potential that this will might be challenged or causing issues, at that point, you do not want to necessarily be sharing that document with a lot of people. I wouldn't be recommending giving it out to all the children, but you do need to make sure your executor knows that they are appointed and that they know where to locate that will.
As well as those who, as you noted, have appointed guardians for minor children. Thankfully, I have some great sisters who have stepped into that role in the past, but we definitely had that conversation as who was going to be the person to step up when my children were minors. So thank you so much, and I will let you continue. I just note that about 38% of you have indicated that your executor does not know that they are the executor. So I may strongly suggest, as Trina has indicated, that maybe you just give them the heads up.
Mm-hmm. As we've discussed, Todd and Jennifer have now implemented and put their plan into place, and Jennifer's family trust has been created, and both parties have executed wills, as well as the supporting documents, power of attorney, and representation agreement. If we revisit the scenarios now, if Jennifer were to pass away, the funds will remain in the trust, and the trust has very clear guidelines about who will receive, which would be the twins, and about what time they should be distributed. So the trust will continue on past Jennifer's death, and there's no concern at this point about a payment to the kids at 19. There's no immediate, will continue to be distributed and managed according to her wishes. We won't have probate fees in this situation because, again, Jennifer is passing away and those funds aren't in her personal name. At the time of Jennifer's death, the spousal loan is forgiven, and Todd retains the $1 million plus all the growth that he has managed to successfully make on those funds. And those funds will pass through his will, which we will touch on next. And Todd also will retain the family home, which again, if he were to then pass away, the family home would pass through his will. So this is much more of a clear reflection of what both of their wishes were. And although Todd's son still doesn't receive in this situation, what we see is Todd receiving a significant amount that would eventually flow to his son through his will. If Todd were to pass away under this scenario, there would be no impact on the family trust, and Jennifer would receive the family home. Todd's estate will have the $1 million plus all of the growth that he's earned, and his estate, his son will be the beneficiary of his estate. While that loan would still be a debt payable by the estate, Jennifer is not going to demand an immediate payback of the $1 million. That's not the intention. That wouldn't make sense to anyone. Interest could still be paid, but ultimately at the time of Jennifer's death, then that loan will be forgiven and the money will ultimately flow to Todd's son. And now in this case, if Todd and Jennifer were to die simultaneously, again, the funds will remain in the trust. Jennifer's wishes will still be carried out with respect to the twins, and there will still be no probate fees with respect to that amount. The spousal loan would be forgiven. The $1 million will flow to Todd's son through his estate. And the family home, again, will be distributed, as we talked about before, with 50% going through to Jennifer's estate to the twins, and 50% being divided 3 ways between the twins and Todd's son. But the big difference here, when we talked about that scenario before, that's all Todd's son was receiving, was that $200,000 approximately that he might get from that. In this case, he now has upwards of $1 million that he's receiving from Todd's estate because of that spousal loan. So what we've really done here is that we've really balanced it out, and the amounts that are being received reflect now more what the parties were hoping for all children to benefit. And in Todd's will, there were very clear trust provisions put in dictating at what age his son would receive any funds that he receives. So we also have that protection of making sure that kids aren't receiving money at too young of an age.
Everyone's sleeping better too. Yeah, perfect.
Into our very last poll question at this point, and then we're going to turn it over to Q&A. We've got some great questions that clients have posed in the chat. Again, it's available on the right-hand side of your screen. So why don't we start with the poll question, and then we'll roll into the Q&A. Again, please don't hesitate. You have the benefit of these two amazing professionals that can answer questions, and they're not charging you for it. Just joking. Perfect. So here's our last question. Do you complete your own tax planning, or do you work with an accounting professional? Perfect. Well, again, I can tell you that from many past experiences, when clients have actually taken past returns in to see an accountant to have a revisit, they've had very positive outcomes. So again, I do recommend, if you have any complexity to your tax planning circumstance, to do seek out the advice of a professional like Jennifer, as well as in regards to your estate plan, seek out Trina or someone who's qualified in that area. At this point, we're going to go into some questions, and currently I have a couple great ones. With the pandemic currently, and sadly the loss of so many of our elders, is receiving probate being delayed, Trina?
It is. It's being delayed in all aspects. When a grant of probate is applied for, this is when you submit a copy of the will and supporting documents to the court, and the court will then issue a grant of probate, and that grant says that they confirm that they accept that this is a valid will, and the executor does have the authority to carry out their role as executor. You need this grant of probate before financial institutions will allow you access to any accounts that form part of the estate, and you need it to deal with any real property held by the estate. With this process, the initial thing that we do is that we'll do searches and figure out what the assets are. And part of that is communicating with financial institutions. That step is taking a lot longer. Just with working from home, it's just taking so much longer on all aspects to get information. And then also at the point when we are filing the documents with the court registry, again, everything's understandably just taking that little bit longer. So it is important to be prepared that it could take upwards easily of 6 months, whereas before maybe 3 months would have been reasonable. And even when things are moving quickly, it's at least usually 3 months minimum before you can get the grant of probate, because there's a period of notice that you have to give. So probate doesn't happen immediately. And one quick point that I'll make on this that's important to consider, the way your assets are structured. So if all of your assets are just in your sole name, understanding that there will be a freeze period where it will be very hard for anyone managing your estate to access those funds. So just making sure that you're thinking about your dependents and making sure that people will be able to meet their needs during that period. And also considering that if you have an estate where the probate fees would be upwards of $70,000, just making sure that that money is actually available and that it's not all sitting in real estate, or it's not all sitting in corporate shares that would need to be liquidated, because you have to actually pay those probate fees before you can receive the grant of probate and deal with the assets. So if you're going to have big probate fees but you have no liquid cash in your estate, you need to come up with a plan as to how is your executor going to deal with that and come up with the money. So sorry, a bit of a segue there, but an important topic that's not considered enough.
I just have another question that's come in. One of our valued clients is asking, how are spousal loans forgiven upon death? Which is a great question.
I'm glad, I think it was Pearl that brought that one up, right? I'm glad she brought that up because I almost interjected. In this case, the spousal loan is being forgiven to meet their estate goals and objectives. Spousal loans are not always forgiven on death, so that's not a has to be. Spousal loans can be collected back, and then the executor would be executing the wishes as outlined in the will. So it's a tool that's used to even out the spousal tax rates in the lifetime, and it does not have to be forgiven on death. In this case, that was just the fact that that's what they wanted to do.
Perfect. So in not all instances are the spousal loans forgiven. Great.
No.
And that there highlights on the importance of having your accountant and lawyer communicate so that the lawyer actually knows to implement that forgiveness and put the appropriate clause in the will.
Perfect. One of my dear friends in Victoria has a question for us. I will keep this confidentiality, but he's indicating that his will create a trust for his lovely wife. This is his second marriage. My children from my first marriage, sadly his first wife had passed, are going to be the beneficiaries. The trust gives its income to his wife. His question is, are capital gains of the trust income taxable to the second wife?
Oh my goodness. Will creates trust. Beneficiary. The trust gives its income to. So I mean, when you die, your final tax return is going to be deemed to have disposed of all your assets at fair market value. So if some of your assets are held by a trust, then that doesn't form part of your estate. So if we're talking about a family trust, so I guess that's why I'm wondering if capital gains of the trust. I'm a little confused. So sorry.
I think, Jen, if I can jump in, what this would say is that after the will maker passes away, the assets of the estate are then held in trust, and the terms of the trust that only comes into existence through the will at the time of death, those assets are held in trust for the spouse, and she has the right to any income that's earned on those assets. And then when that trust ceases to be, then the assets will flow out of the trust outright to the kids. So I think that's the question during that time after death, when these assets are held in trust, earning income, and the income is going to the surviving spouse.
Yes.
If a capital gain arises, or I guess just who bears the tax consequences in general there?
Yeah, so before the trust, so after someone passes away, their assets are in the estate trust, and then the estate, before it distributes it, the estate then is taxed on that income. So it has its own tax return, and you do get gradual rate, they're called gradual rate estate, where you get the personal tax incremental rate. So it's not all taxed at the high level, but it's taxed as if it was an individual. You get that up to 3 years after someone has passed away. So the idea is the executor is going to need some time to figure out how the assets are to be distributed. In the meanwhile, the estate would be responsible for any gain past the date of death on the assets, the underlying assets that the trust holds. So the trust itself would pay tax.
Perfect. We have one more question we'll cover before we wrap this up. Jen, this question was posed by one of our clients. With the budget being delayed and the growing deficit, obviously due to the COVID relief, what changes do you think we can expect in the coming year or two regarding tax increases or changes?
Yeah, well, that's a great question, Jill, and it's definitely a hot topic. We've actually been anticipating the inclusion rate for the capital gains tax. So right now, capital gains are only 50% of it. It becomes part of your taxable income. We are anticipating that they increase that to say 75%, like it was years ago. And this was pre-COVID. We were anticipating this for almost 4 budgets in a row now. So with all that's going on out there and all the funding that the government is providing, now more than ever, we anticipate that inclusion rate being increased. And what that really means to folks is that if you're triggering a capital gain, your tax cost on that is going to be greater in the future. Of course, this is speculation at this point, but there's a lot of different folks out there thinking that this is part of the way the government's going to help solve their challenges here. So we'd never want to have gains triggered on speculation just to prepay tax. However, if you're in a situation where maybe you have a bunch of capital in a corporation and you really foresee spending that in the short term, it may make sense to be triggering some of those gains in advance of budget. And we were glad to have it pushed back a little bit more time for these transactions. Talk to your advisors.
Great. Well, I want to thank you both so much, Jen and Trina, for joining us. Sessions like this remind us how important and complex estate planning and tax issues can be. And again, recommending seeking professional advice. We really appreciate, I'm losing my tongue here. We appreciate you taking the time out of your busy schedules to join us and our viewers. Janice, as a token of our appreciation for both Jen and Trina joining us today, is going to make an individual donation to their charity of choice. And it just happens that both Jen and Trina individually chose the Nanaimo Foundation. So that's a great opportunity for you to give locally. And we actually have heard from the director of the Nanaimo Foundation that they're thrilled to be receiving that donation. So thank you very much. At Genis, we have a team of professional portfolio managers that focus on investment management and cash flow planning. Not only do we ensure your investments meet your needs and reflect your values, we work with experts like Trina and Jen to ensure your portfolio also makes sense from estate, income, and tax planning, as well as financial planning perspectives. Please do reach out to your portfolio manager if you have any questions about today's presentation. If you are new to Genis, please reach out to us via our website. If you have any suggestions for topics of webinars in the future, we'd love to hear your feedback. And if you have time before you log off today, we are going to have a quick feedback survey appear on the screen. If you missed part of the session, it will be recorded and we will be posting it on the Genis website. We appreciate your business. We appreciate, obviously, the local professionals here on the island that I work with. And I wish you all a great day. Stay safe, stay healthy.
Thanks, Jill.
Thank you.